Assalamualaikum warahmatullahi wabarakatuh. Good morning, good day, good afternoon, or good evening. Anytime you watch this video, I am now taking this video in my room in the faculty. This is my private room. It's not ready yet as the office. I will have it prepared for the next few months. Today we will study chapter 5 about statement of financial position and statement of cash flows. I will divide this video into two videos since this topic is quite long, so that you can also enjoy it at your own pace or at your own speed. Okay, let us start with the statement of financial position. Okay, statement of financial position. This chapter 5 has two topics actually. First, there are 4 learning objectives. The first one is after studying this chapter, you should be able, 1, to explain the uses, limitation, and content of statement of financial position, and to prepare a classified statement of financial position. It means to prepare here is not to prepare financial position from the scratch, from the transaction. It's not like that actually. It's only about how you can arrange accounts into a correct financial position. And the learning objective number 3 and 4 is to explain the purpose and content and preparation of statement of cash flows, and to describe additional types of information provided. These videos will be provided into 2 videos. The first video is only on learning objectives number 1 and 2, and the second video will be on number 3 and 4. Okay. This is the preview. So this is the division of our study. So this is these 2 topics will be covered in the first video, and later topic will be discussed in the second video. So what are the statement of financial position? Earlier it is called balance sheet, or in Indonesia it is called neraca, but in Indonesia now it is called as laporan posisi keuangan. So this statement first report assets, liabilities, and equity at a specific date. So this keyword must be understood by all the students, that the word position means that it is on a specific date, not on a certain range of period, but only on a specific date. And the second one, it provides information about resources, about obligation to creditors, and equity in their resources. This number 2 actually relates to the first definition, since resources means assets, obligation means liabilities, and equity means equity. And the third one, it helps in predicting amounts, timing, and uncertainty of future cash flows. So by analyzing financial positions of several years, it will help investors or creditors to predict the amount, timing, and how certain is the future cash flows of a company. So this statement is useful for predicting future cash flows also. This is the usefulness of statement of financial position. First, we can use it to compute rates of return. In financial management course, you will be introduced how to calculate rates of return. And then second one, to evaluate capital structure, since the capital of the company is stated there in the form of let's say equity. And the third one is to have company to assess risk and future cash flows of that company. And the fourth is to assess company's liquidity, solvency, and financial flexibility. And these topics actually you can learn it in the financial management the first or the second. If I'm not mistaken, it will be on the first course of financial management. So this is those are the usefulness of statement of financial position. But this statement also have some limitation. And the first one is that all the assets and liabilities are reported based on the historical cost. It means that if you have the company reports, for example, it has cash, it has planned assets or truck, for example, on December 31, 2019, let's say the amount of it is 1 billion rupees. The 1 billion rupees is based on the acquisition cost of the assets. For example, if I bought the truck in 2015 for 1 billion rupees, it means that the asset has cost of 1 billion rupees, and I have to depreciate it during the lifetime of the assets based on the historical cost. So when you look at financial position, I'm giving you a financial position from a company called FIFA. For example, here we have assets of, let's say, this one, fixed assets. This one, fixed assets. Sorry, I have to use the translated one. This one is fixed assets of 839 billion rupees, for example. This is the cost of the asset minus the depreciation of the asset. So this number is not the market price of the assets, but it is the cost of the asset minus the depreciation of the assets. And let us look at the explanation notes on notes number 10 here. I will show you notes number 10. This is notes number 10. This is note number 10. Notes number 10 on the fixed assets. You see that the fixed asset is here. This is accumulated depreciation of that asset. This is the continuation. Okay, we have it here. This is fixed asset. This one is the cost of that fixed asset of 1.997 billion or million. I believe it is million. It is in thousands. It is trillion rupees. So this is the cost of the assets, and those are the accumulated depreciation of the assets. So this one, the 800 billion rupees, is the cost, the carrying amount of the asset. So if it is said here that limitation of the statement of financial position, assets and liabilities are reported based on at historical cost, it means that the number that we are reported in the financial statement of financial position is the number based on the historical cost. So it is not the cost, it is not the real cost or the fair value of the asset. What I mean by fair value is the cost of the asset as of that day, or the price of that asset as of that December 31. And then it used judgment and estimates. Let us come back to here. This one, the accumulated depreciation number here or here is the number that the number here is based on judgment. Judgment of what? Judgment of the useful life of that asset. Judgment of the best method of depreciation to be used, or something else. So those number here that we have here, the total accumulated depreciation is based on estimate, on judgment. So this number, whether it is 1.195 billion rupees or 800 billion rupees, is only an estimation. This is an estimate. This one is estimate. This one also an estimate, not the real number, not the exact number. For example, when we said in physics, if we said that this from right hand to my left hand is 30 centimeter, everyone will agree with it as long as we use the same ruler or measurement. But in accounting, when we said that I have 800,000 or 800 billion rupees of asset, it means that it must be on your based on your judgment. So it is only an estimate. It is not the real number. So this one, that's what I mean by judgment and estimate. And many items of financial values are omitted from our financial statement. For example, here it is stated that no statement on the value of the employee of the company. So everything on the financial statement of financial position, only one that can be valued monetarily, not anything that cannot be measured monetarily will not be on the statement of financial position. So those are the elements of our statement of financial position. First one is assets, second one liability, and the third one is equity. Assets are comprised of resource controlled by the entity. It is the result of past event and has future economic benefit expected to flow to the entity. So these three definition is very important. First one, that asset is something that the company control, not the company own. So you see here, the word is control, the word used is control, not own. It means that the company doesn't need to have something as their own property to be able, or to be put in the statement of financial position. It only has to be controlled by the entity, so that the company, that asset should be put into the company's asset. For example, like this. If I plan to have a car, for example, and that car is, I bought that car through a leasing company, it means that the asset is not my assets yet, but since I signed a contract with the leasing company that I will pay installment for the car, let's say for the next 3 years, so the assets is controlled by me. It is not my assets yet, since let's say the price of the car is 300 million rupees, and I only have the down payment, let's say 10 or 20% of the price. So it is not my property yet, but it is controlled by me. So I have, or I need to classify it as my asset, since I have the control of that entity. This is the first and the most important definition of the asset. And the second one is it must result. It is the result of past events. So something that has not happened in the past cannot produce an asset. And the second one and the third one, we expect to have a future economic benefit expected to flow to the entity from the controlling of the asset. And the liability, it is the present obligation of the entity. So present obligation, it means that you owe that obligation today, and it arises from the past event, and you need to settle it in the future. So there will be some outflows of resources or assets in the future, so to settle that obligation. And what about the equity? The equity is only a residual interest in the assets of the entity after deducting all the liabilities. So if we put those three into an equation, assets equals to liability plus equity. So the equity, only the residual interest in the assets of the entity after you deduct all the assets with the liability. Okay. So those here we have sub-classification of assets. I will show you real earnings, real statement of financial position later. Let us see here. We have assets, we have equity and liabilities on the right hand of the statement, and this is the left hand. Let's say left hand, this is right hand. So the right hand, we have assets, left hand we have assets. Based on the liquidity, it is non-current assets on the top, and the current asset on the lower part of the statement. But here in Indonesia, we put current asset up and non-current asset below the current assets. And then it is the same here. Oh, sorry, it is not the same also here. They report equity and then liabilities, but in Indonesia we report liabilities, especially current and non-current. Current first, second non-current, and the third one is the equity itself. So non-current assets consist of long-term investment, property, plant and equipment, intangible assets, and other assets. While long-term investment could be in the form of securities like bonds, ordinary share, or long-term notes, and tangible assets which are not currently used in the operation, For example, is the land that we held for speculation. Speculation means when the price is good, we sell the assets. And some special funds, for example, sinking fund, pension fund, or plan expansion fund. So those are funds that we put aside to finance future projects or future obligation. So those are the sinking fund or the plan expansion funds. And those are also non-consolidated subsidiaries or associated companies reported as long-term investment. So there are three types of investment in debt and securities. The first one is held. It is called held for collection. Mostly it is debt. Held for collection, it means, for example, Bank of Indonesia or Bank Indonesia emit or release some bonds. The bond will due in the next 10 years, let's say in 2030. And you buy that bonds, that government bonds. When you buy a bond, there are two gain that you can collect from buying that bond. First one, gain from selling the bond before the bond mature, it means before 2030. And the second one could be gain resulting from interest and resulting from the money that will be given back to you as the principal at the end of the life of the bond. So there are two motives that an investor to have investment in debt or equities. First, you hold it for collection. It means you hold it for the whole life of that bonds or debt, and then you will collect the interest and also the principal amount of the debt. It could be trading. So trading means you sell the bond after you buy the bond, and then you wait for the right price, and when the price is right, when the price is high, you sell the bond. So held for collection mostly on that. The trading one that I just mentioned earlier is debt, could be debt in the form of debt or equity, and the third one is non-trading equity, could be in the form of equity. So the valuation of those investment is different. If it is held for collection, it is amortized cost based on the cost. But if it is trading either equity or debt, here we use fair value. Don't sweat about this. We will have it on the intermediate financial discussion later in the later semester. So the classification could be here in the statement, could be current and non-current for held for collection, but trading must be current. But non-trading could be current or non-current also. So this is the sample of how the long-term investment reported in the statement of financial position. Here we have investment in held for collection securities as much as maybe 2,000 something. Okay. Later I will show you from the other real financial position. So we come to property, plant and equipment. This is fixed asset. It is tangible, long-lived asset used in regular operation of the business. So Assets classified as property, plant and equipment or PPE must be tangible. First, must be tangible. Second, must be a long-lived asset and used in regular operation. So the physical property could be land, could be building, machinery, furniture, tools, or wasting resources. For example, and the exception of land. So those assets will be depreciated or depleted, except of land. Land cannot be depreciated or depleted. Here, the report of the PPE. Here you can see that land is reported as it costs, but building must be depreciated with deducted with accumulated depreciation. And later, intangible assets, it lacks a financial physical substance, but not financial instrument. Could be in the form of patents, copyright, franchise, goodwill, trademarks, trade names, customers list, and so on. It must be amortized with limited life bid over the useful life. We have a special chapter for this, so don't worry about this right now. You only need to know it. Those are the intangible assets reported here. So those are the numbers is the total non-current assets. And there are under sub-classification called other assets. This could be vary from companies to another companies. So let's say could be long-term prepaid expenses, non-current receivable, asset in special funds, property held for sale, or restricted cash or securities. And then we are in current assets. Why it is called current asset? Because this word current relates to the readiness of this asset to convert into cash or to sell or to consume. So the current asset is the asset that can be converted into cash or can be sold or can be consumed readily as compared to fixed asset. So the word current here relates to this word, either in 1 year or in the reporting cycle. This is the other prescription for the current asset. What are the current assets? Could be inventory, could be prepaid expenses, receivables, short-term investment, and cash. Cash already in the form of cash, but cash equivalents is not cash yet, but readily convertible into cash. So this is the basis of valuation. What is the valuation? Actually, in accounting, there are 3 jobs of an accountant. 3 main jobs. It is my opinion, but you can check in the other any accounting book that the first job of an accountant is to identify whether an event or a transaction will result in the change of assets, liabilities, or the equity of an entity. If something happen and it will result or it will change the amount of assets or the amount of liabilities, or as a consequence the equity, it means it is an accounting event. So this is the first job of accounting. But after the assets is after the event or transaction is classified as an accounting event, the first job, this is the first job actually, the first job of the accountant, of an accountant, is to measure the amount of finance, amount of money to be effected from that event or from that transaction. This is the first job. The second job, let's say it happens in January 1. And the second job of an accountant is, it relates to the end of the period. It is on December 31, let's say, or in between from January 1 or December to December 31. Let's say it is we are now in December 31. I bought, for example, a car in January 1, 2020. Now we are in in December 31, 2020. 2020. Let's say the car price was, or the cost was 300 million rupees. And now we are in, after a year, the the value of my car must have been consumed. I drove that car. I run that car. I used that car. So now today, at the December 31, the question that the accountant have, what is the value of that asset on December 31? The value, the key is that most of the time the value will be lower than the cost. So the second job of the accountant is to value the assets at the end of year or at the end of its life. For example, I need to sell the car before December 31, for example. So at that time, I need to estimate the value. So valuation here is to determine how much is the cost, how much is the value of certain assets at the end of the year. So this valuation here, it happens at the end of the year, or at the end of the life of the assets, or the cycles of the assets. So the third job of an accountant is to report it. So here, what I mean here, this basis of valuation is needed because the accountant needs to determine the value of the asset at a certain date, mostly at the end of the year. So you must keep in mind that there are three jobs of an accountant, and this is these relate to the second job of an accountant. And comes to the inventories here. With this close basis of valuation is lower cost or net realizable value. We will study it later on chapter. If I'm not mistaken, it is on chapter 7 and chapter 8, and then the cost flow assumption also on chapter 7 and chapter 8. This is how they report receivable. So receivable is something that the company expect to have from the credit sale of their inventories. So when I sell my inventories in credit, I do not expect to have cash rightly, but I expect to have the cash later. Could be 1 day, 2 months, 2 weeks, or 6 weeks, or could be never received again. So the company needs to anticipate some loss due to uncollectibles. If I sell in credit, that customer could pay or could never pay the money back to me. So I need to anticipate the loss because of that. And then we have to identify the amount and nature of non-trade receivables. There are non-trade receivables. So, and the third one, we have the receivable could be used as collateral. Collateral means in Indonesian means jaminan. It means something that we use as assets. Yeah, it is as collateral when we let's say need to borrow some money from other entities. So this is how we report receivables. Account receivable as cost, as it costs, and then less allowance for some doubtful accounts. And then later prepaid expenses. This is expenses that we pay in advance of the service that we expect to have. For example, most of you may have let's say you rent a room or you rent a house during your study. You pay 1 year in advance. So let's say 1 year you pay, let's say 2 million rupiahs. So this 2 million rupiahs is a prepaid expenses. You pay the expenses in advance, so you consume your expenses, your assets by by the running of the time, let's say like that. Okay. This prepayment of prepaid could be in the form of insurance or supplies, could be in the form of advertising. For example, you pay for an advertisement in a TV, in a television. They promise to promote your company or your products in their television. So you pay, let's say, for the next 1,000, let's say 100 hours or 100 minutes of advertisement. So this is the kind of prepaid expenses that you need to pay. Could be rent, could be taxes also. And this one, and then short-term investment, the same with long-term investment, could be the motive could be help for collection, could be trading, or could be non-trading. It is the same with long-term investment. And the last one is cash. Cash generally is the currency, or could be a demand deposit. The currency means here is the money or the money that you can or normally use for payment or in your operation. It is not the money that you cannot use as payment, right? Okay. For example, I have $1 of Republic of X, something, a country that nobody knows in Indonesia. You cannot say that you have a cash based on that currency. This is only a currency that normally or acceptable by business. Then there are cash equivalents. It is must be short term, highly liquid, must be matured within 3 months or less. And there must be no restriction or commitment related to this cash. For example, I have a bank account with the amount of, let's say, 100 million rupees. But those 100 million rupees, the purpose of that account is to let's say, an anticipation of opening a plan that we have planned, let's say in 5 years time. So this money, this 100 million rupees cannot be classified as cash, since it is restricted to be used, or there are commitments to those money. So it is not cash, even though it is in the form of a deposit. Okay, so it is must be readily available to use. And the last one is share. There are share capital, there are share premiums, there are return earnings, there are OCI, accumulated other comprehensive income, and treasury shares. Those topics will be covered by later chapters. So those are equities, and then current liabilities have types is okay. I'm sorry, we are not in at the end of the chapter later. Okay, those are current liabilities. Current liabilities must be arise from specific financing situation. Could be from ordinary operation, could be depend on the occurrence or non-occurrence of one or more future events. So those non-current liabilities have characteristic that we do not expect to liquidate it within 1 year. It must be liquidated more than 1 year, or the normal operating cycle, which one is longer, right? So this non-current liabilities, and the current liability is one that we will settle within 1 year, or within normal operating cycle, whichever is longer. So by normal operating cycle means that a normal cycle of a company could be longer or could be shorter than 1 year. A normal operating cycle is a cycle when you have cash, you convert into inventories, let's say inventories, and after inventories you sell, it converted into receivable, and then after receivable you convert it into cash again. This is one normal operating cycle, from cash to inventory, or to raw material to finished good to inventory to receivable into cash again. This is the normal operating cycle. So whichever is longer, it is the current liabilities follows it. Include several items: payables resulting from acquisition of goods and services, could be collection received in advance for delivery of goods or performance of service. So this one kinds of prepaid expenses that you receive from your customer. So those are current. IFRS does not specify the order or the format of the statement. There are two types: account form and report form. This one is a report form. So those are assets, those are equities and liabilities. They are in the same column, in one column. But the report form will be and using account form, there will be two. So this is the end of statement of financial position. I will show you statement of financial position of two companies. This one is Bumi Resources, the one that the company that I showed you earlier last week. So here we have assets. This is the Indonesian company. Here they report assets, and then current assets, and then total assets. So this is a report form where assets, liabilities, and equities are in the same column. Okay. In the liabilities, they report current liabilities, and then non-current liabilities, and then later equity. So come back again into current assets. Current assets, here you see that those are cash, and then restricted cash in bank. So you see that they have cash that is readily available to be used, and one form of cash, so it is not cash because it is restricted in the bank. And then they have trade receivables, whether first is to third parties and to related parties, and other receivables, third parties, other receivables, and third parties, inventories, taxes recoverable, prepaid expenses, disposal group classified as held for sale. So they have assets that classified as held for sale. And then non-current assets due from related parties. So they have receivable from their related parties, and they have deferred tax assets, investment in associate and joint ventures, fixed asset, mining properties, exploration, and so on. So those are total assets. And here we have liabilities and equities, current, non-current. Current are short-term loans, trade payable, third parties, divided into third parties and related parties, and other payables also to third parties and due to government, and accrued expenses and taxes payable. And then you see here, there could be new to you that there is current maturities of long-term liabilities. So this portion, this 99 something, is long-term loan that will be matured within a year. So earlier this 99, okay, you see here, this 144 something in 2018 was a part of this number, which one? Liabilities, non-current liabilities. So a portion of non-current liabilities in 2017 will mature in 2018 or 2019. Let's say in 2019. So the portion that will be matured within 1 year must be classified as current maturities of long-term liabilities. So this 144 earlier belonged to these non-current liabilities. So those are non-current liabilities. You can study it by yourself. Later in its own chapter we will study it. So those are equities. And see here total liabilities and equities. Okay, that's all for this part, and we will meet again in the second video. Okay, good morning, good day, good afternoon, or good evening to you all. Assalamualaikum warahmatullahi wabarakatuh.